Hi, welcome to our course on personal loans. What we want to do here is to develop a working concepts of what we went over in managing credit. Most people think that credit card debts are the most popular debts, but there are larger debts that we're looking at: personal loans, mortgage loans, car loans. Those are more of the type of credits that people are looking for long term as opposed to just credit. We're going to go over some of those type of loans here, how to obtain those type of loans, and understanding what those loans really are. With that being said, let's get started. Personal loans are used to cover larger expenses that our cash flows cannot. Personal loans are paid on an installment basis, and their interests are a lot cheaper than credit card payments. Loans can be provided from a number of institutions, such as commercial banks, savings institutions, financial companies, and credit unions. We had a course earlier on using financial statements as a tool for developing a financial plan. Again, we're coming back to the balance sheet and the cash flow statements. If you don't remember, a balance sheet serves as a snapshot of your current liabilities, your assets, and your net worth. What a balance sheet does, it gives the lending institution the opportunity to see what assets you have to cover the potential default on your loan. What the cash flow statement does is it shows your cash inflows and your cash outflows, which is showing your ability to make those loan payments. Meaning, if you're making $5,000 a month and you're spending $4,900 a month, and your car loan payment that you're about to add on is $349 a month, obviously you're not making enough money to cover that debt repayment. And that is going to show a lending institution that you're incapable of making those payments. A couple of definitions. A loan contract is the agreed upon term between the lender and the borrower. A loan contract embodies the following information: the amount of the loan, which is based on the requested amount and what the lender believes you can actually pay back. Let's say, for instance, you request $10,000 for a car loan, and the lender thinks that you can only afford $9,000. They're going to ask you to come to the table with an additional $1,000 towards the car. It discloses the interest rates that you have to pay on that particular loan, and it specifies your loan repayment schedule, meaning the length of the loan, the principal, and the amount of interest that's being paid on the loan each month. And with any of you that already own a car or own a home, the longer you pay off your debts, the more money is being allocated towards your principal balance. And of course, the maturity date, meaning how long you have the loan. With mortgages, 15 years, 30 years, there are other years that now there's a 10-year mortgage that's come out. A car loan, it could be 5 years, 7 years, 2 years, whatever the case may be. This is the type of information that's in all loan contracts. What is the maturity? In regards to your loan, what you want to do or try to do is make the loan as short as possible relative to your actual ability to repay. And if in the event, let's say for instance, you took out a 15-year mortgage, but you're liquid enough and you have enough cash inflows and very few cash outflows to actually pay your mortgage off early, it's best to do that. Although some may say don't do it because you want to maintain that good credit score by maintaining that long credit history. The amount of interest that you're paying on a 15, 30-year mortgage it's a lot. For instance, if you have a $200,000 home and your interest on your home is 5.5% interest, you're paying double the price of your home initially. And when you take into account over that 30 years, there's going to be inflation, and the average inflation being between 2 and 3% a year, the value of your home is not actually going to be worth as much in the future as it is now in a lot of cases. What is collateral? Collateral is the tangible asset that you have that would be taken in the event that you default on your loan. These loans are called secured loans, meaning if you take out a mortgage, your mortgage is collateral for you not repaying. Cosigner, most of you know what a cosigner is. It's an individual that has really good credit history that will sign on your behalf to guarantee that on the behalf of you, they will repay your debts in the event that you default. These are the different definitions and the different type of interests that are added onto your personal loans. You have the APR, or annual percent rate, which is a rate that measures the financial expenses, including interest and other expenses on the loan over the course of the year. You have simple interest, and you have add-on interest. Take a second to pause to read to the definitions if you'd like to. I'm going to move on to the next slide. In a home equity loan, your home serves as the collateral for the loan. Calculating the equity of a home is equated by subtracting the debt owed on a home from the current market value of the home. Let's say, for instance, the market value of the home is $200,000 and you owe $160,000 left on the home. Your equity is $40,000, so you can borrow up to $40,000 in equity from your home. A home equity loan is looked at as a line of credit. Most financial institutions let you borrow up to 80% of that equity on your home. If the market value of your home rises, an institution will be more willing to extend a greater line of credit. Meaning you owe $160,000 on your home. The next year, your home goes up to $270,000 as opposed to just $200,000. They will extend that line of credit, or they'll extend that loan to you. Interest rates are lower on a home equity loan because one's house is collateral for the risk of the loan. Home equity loans are also tax deductible for up to $100,000. So individuals make out better at times using an equity loan as opposed to a credit card or other types of loans. Here's some basic information on car loans. This is something that most of you are going to be familiar with over any other type of loan that I've talked about on personal loans. More people are going to take out car loans and mortgage loans throughout the course of history in general. So I'm not going to go into too much detail on this. If you'd like to pause, take a second to read through the information on this particular slide, go ahead and do so. This is the end of this course. I hope you learned some things. I look forward to seeing you guys again soon.